The U.S. stock market is currently closed. Bigbear.ai Holdings Inc., trading under the ticker BBAI on the NYSE, closed the last trading session on Monday, December 1, 2025, at $6.06, marking an intraday change that saw the stock fluctuate between $5.98 and $6.23 on relatively high volume. While the immediate focus might be on that end-of-day price action, which was a slight pullback after a period of intense volatility, the truly compelling insight here lies in the institutional maneuverings that occurred after that price was set. The recent successful stockholder vote to increase the authorized share count to 1 billion. This move, which passed with a significant majority, is the single most critical yet underappreciated development that investors need to grapple with right now. On the surface, the market narrative surrounding Bigbear.ai has been quite clear for some time. It's an AI pure play, riding the secular wave of defense and intelligence spending, evidenced by its robust contract backlog and a string of headline-grabbing, high-profile project wins. Investors have been willing to overlook the company's continuing lack of profitability, banking on the promise of its government-centric decision intelligence software, and more recently, the aggressive move into generative AI via the acquisition of Ask Sage. The general expectation is that this is a long-term growth story, punctuated by periodic government contract announcements that cause sharp spikes in the share price. However, the reality of the business's operational and financial structure, particularly in light of that share count increase, demands a more cautious and nuanced interpretation than the simple AI stock goes up narrative allows. The immediate stock movement in the preceding weeks before the latest close was dominated by two primary catalysts: the third-quarter earnings report and the Strategic Partnership Memorandum of Understanding, MOU, to develop an AI-driven aerospace hub in Malaysia. The earnings, reported on November 10th, were a mixed bag. The market reacted strongly to the positive news that the company had a definitive agreement to acquire Ask Sage, a highly strategic generative AI platform that is FedRAMP High compliant, which is a significant barrier to entry in the government space. This news created a substantial momentum burst in the stock, suggesting that investors are prioritizing the build-out of a next-generation AI platform over current financial metrics. However, buried within the report was the reality of continued margin pressure and the withdrawal of adjusted EBITDA guidance due to contract timing disruptions. This tension, headline excitement versus financial fundamentals, is the constant struggle for BBAI investors. Trading volumes spiked dramatically following these announcements, routinely hitting daily figures in the tens of millions, far exceeding the typical average volume, indicating a high degree of retail and short-term institutional speculation. Following the initial spike, the stock experienced a predictable yet aggressive retracement, a textbook example of profit-taking after a high-profile announcement, which confirms that the majority of the buying pressure remains speculative and event-driven, rather than based on a steady accumulation of shares by long-term holders. Now, let's address the elephant in the room: the vote to increase authorized shares. This is where expectation and reality diverge sharply. The expectation is that a higher share count simply gives the company flexibility for future mergers and acquisitions, or for employee compensation plans, which are palatable and future-looking reasons. The reality is that in the context of a company that is still burning cash, has a high valuation multiple relative to its peers on a price-to-sales basis, despite being significantly undervalued compared to its high growth potential in the eyes of many retail investors, and is trading at a significant discount to its trailing EPS, this vote is often the precursor to a significant capital raise through a secondary offering or an at-the-market offering. In simpler terms, it's a structural move that makes future dilution significantly easier. Considering the total shares outstanding are around 436 million, the authorization to essentially double that count to 1 billion presents a material risk to the existing shareholder base. This is the unexpected angle that drives curiosity and, frankly, warranted concern. The market's initial reaction was relatively muted, but the underlying threat to the price per share remains active and must be factored into any forward-looking analysis. The company needs cash to continue its aggressive growth strategy, especially with the Ask Sage acquisition, and selling more shares into the market is the most straightforward, though dilutive, path. This brings us directly to the dynamics of short selling, which are deeply intertwined with the company's capital structure. Bigbear.ai isn't just an AI stock, it's a highly shorted AI stock. Recent data indicates a significant portion of the free float is sold short, with one recent report placing the short interest as a percentage of float above 24%, equating to over 100 million shares sold short. This high ratio is immediately actionable information for any investor. It indicates a massive bet against the company's valuation and its ability to achieve profitability before running out of capital. The short-selling thesis is straightforward. The company's market capitalization is inflated purely based on the current AI hype cycle. Its contract backlog is subject to government delays and is not a guaranteed revenue stream. And the business model, which involves high R&D and acquisition costs, will lead to further debt or heavy dilution, forcing the stock price down to a more fundamentally justifiable level. The days-to-cover ratio has been relatively low, sometimes under 1.3 days, meaning the short sellers could theoretically exit their positions quickly without a major price spike, which lowers the immediate short squeeze risk often discussed on forums like Reddit. However, the sheer volume of shares shorted still provides a significant pool of future buying demand if a genuine, sustained catalyst like a massive high-margin contract or a clear path to profitability were to materialize. Short borrow rates, while fluctuating, have remained in a range that isn't excessively punitive for professional short-selling firms, a detail that suggests they are comfortable holding these positions for the medium term. For retail investors, the actionable insight is to monitor the official short interest reports from the NYSE, which come out twice a month, but more importantly, to track the short volume ratio on a daily basis, which has recently hovered in the 30% range. This high short volume, representing the percentage of total daily volume that is short sales, signals persistent bearish pressure. Investors should also pay close attention to the failed-to-deliver data, which has recently seen some spikes in November, though not at the extreme levels that would suggest a systemic delivery issue. This data, while not a smoking gun, is another thread in the tapestry of intense market disagreement over this stock. What institutional investors are doing paints a mixed picture, which is typical for a high-beta, high-risk growth stock. On the one hand, you have major passive institutions like Vanguard and BlackRock holding substantial positions, and they have recently increased their holdings, but this is largely due to the index-tracking nature of their funds. On the other hand, you have hedge funds like Citadel and Marex Group making significant aggressive moves, sometimes reducing or adding dramatically respectively, suggesting active, high-frequency trading around momentum and news events. The recent 13F filings show a substantial increase in total institutional shares held, which is a bullish signal, indicating that smart money is actively accumulating. However, the sales from insiders, including a director and the CFO in recent months, selling small but noticeable blocks of shares, provides a countersignal. Insider selling is not always a red flag. People have legitimate reasons to diversify, but when it coincides with a major price run-up and a high degree of market uncertainty, it's a data point that shareholders must process responsibly. This institutional duality, passive funds increasing exposure versus active funds rapidly trading, paired with insider selling, reflects the deeply polarized nature of the stock's true value.
Bigbear.ai's business is centered on providing AI-powered decision intelligence solutions, primarily for the U.S. government's defense and intelligence communities, which makes up the bulk of its revenue, but also for commercial clients in logistics and manufacturing. The underlying business model is based on collecting massive, disparate data sets and using proprietary AI models to create predictive and prescriptive insights, helping an intelligence analyst anticipate troop movements or a logistics manager optimize a complex supply chain. The historical performance, particularly in the pre-AI hype phase, showed slower growth and significant operational losses. While the recent contract wins, such as the logistics contract with a government customer and the partnership for the aerospace hub in Malaysia, validate their technology and expand their geographic reach, the core challenge remains translating these major contracts into consistent, high-margin, and predictable quarterly revenue streams. This is the hurdle Bigbear.ai has yet to clear convincingly, and it is the single most important point for the short thesis. Looking forward, the future outlook for